In this video, traders, we're going to look at 6 unusual things that you can trade. Stay tuned. Hey guys, warm welcome to you. Alright, so 6 unusual things that you can trade. Well, perhaps not as a retail trader, but there's 6 things that you may not have realized that can be traded. So let's start out with number 1. Number 1 is freight derivatives that are derived from the spot shipping rates. And if you think about this, a lot of these make real perfect sense. And this is kind of the point of the video, is that you can trade freight derivatives because as a shipper or as a company that uses shipping, why would you want to do that? Well, you'd want to hedge the risk that shipping costs are to your business, the exposure that you've got to shipping costs. If you've got a constant flow of goods going from A to B across the ocean, and it's a big chunk of your pricing or big chunk of your outgoings, let's say you're a company who uses that, then the shipping rates or freight derivatives would be there to lock in that cost. Because ultimately, guys, you think about any person who's hedging, a farmer, a consumer, a producer, they are in the business of the business they're in. A farmer is making money from farming. Kellogg's is making money from selling cereal. They don't want to be in the speculation of corn futures or the speculation of soybean futures. Same with the companies who are involved in shipping goods. They don't want to be speculating on the price of shipping. They want to lock that in and they want to get on with the business, whatever they're doing, whether they're manufacturing and they're sending over and distributing in Europe, manufacturing China, distributing Europe, whatever it may be, you get the point. So these things stem from that. And so shipping companies as well, obviously if they're high, they can lock in and kind of guarantee some revenue and don't want the shipping rates to fall down. So these freight derivatives are tradable, and it's something that you can trade from a speculation perspective as well. It's quite popular. The Baltic Dry Index as well comes from the shipping rates. There's lots of shippers as well that are really sensitive to this shipping rate. If you're a company that's purely based on shipping, a lot of people trade the shippers or shipping companies based on kind of these shipping rates. Anyway, the next one is weather derivatives. Missed off my R, but I've spotted it now. Weather derivatives, snowfall, frost, and temperatures. Again, makes perfect sense, because the amount of people who have companies that are susceptible to weather, good and bad. You've got agricultural, which are going to be obviously susceptible to bad weather, which is why I've got snowfall, frost. If you've got snowfall on certain crops, it's going to reduce the crops. It's going to increase the value of, ultimately, that will also increase the price of that crop because there's less kind of quantity of it in there. And from the other perspective as well, you've got the people who are buying those goods who may not necessarily want to hedge against the actual good itself, like the soybean, the coffee, whatever it is, but they may say, okay, well, this snowfall may well be, we want to isolate this risk and hedge against this risk. So again, same as the first thing, whenever you've got two parties that one wants to hedge against risk, the other wants to hedge against risk, and speculators want to take the bit in the middle, then there's going to be opportunity to trade. You know, speculators are quite happy to offer the other side of a trade because they think they're going to be right, and the company's quite comfortable with the fact that they've hedged out the risk. It's great for shareholders, great for growth, all that kind of stuff. So weather derivatives, they make perfect sense, right? Temperature as well is another one. Certain extremes of temperatures, highs or lows, and I'm sure there are multiple kind of avenues you can go down with that. So number 3, a bizarre one, but I've never traded it myself, on the CME, is cheese. So I wonder what the deliverable of that. I think it's actually cash settled. I don't think you can actually get massive blocks of cheese, which would be quite nice if you're a cheese lover, but regardless, same kind of thing, guys. It's just being able to hedge the risk on cheese. Obviously a big item that's heavily consumed. I'm not sure what the contract specifications, is it mild, is it mature, is it extra mature, is it cheddar, whatever it is, but anyway, you can trade that on the CME. Pretty much not much volume on there, but when there is, I guess the point is, a lot of these things actually, especially the last few, don't have much volume, but I guess the point is that if you're speaking to a company and you don't want to do a kind of over-the-counter contract between you, want to go via an exchange, you can say, well, listen, there's an exchange, we can go on the CME, I can put a bid in. Now, you can't pre-arrange a trade, but there's an avenue, a venue you could go to that potentially would act as that middleman and secure the counterparty risk that you wouldn't get, should I say, otherwise, if you're trading over the counter with another company. All right, so electricity futures. I don't think anyone's surprised by this. It's it's one of these things that everyone uses, and again, it makes sense from a hedging perspective from people who are companies that are producing electricity, right the way down to perhaps factories or companies that are consuming a lot of electricity. Anything where you can hedge out a significant cost of your business from a consuming perspective, or profit source, a revenue source from your business. Anytime you can hedge that out, there's going to be something out there to trade. We've also got things like uranium and stuff which you can trade also. Number 5, carbon credits. This is the right to emit CO2. This has been a big thing in recent years, kind of carbon neutral and all this kind of stuff. Companies can trade carbon credits, speculators can get in the middle of the two. That's another thing you can trade. The final thing is a bizarre one. It's not so bizarre as such or unusual, but there's no volume on it, which is, I think, is a bit unusual. Euro volatility, you can trade on the CME. So just like you can trade the VIX, which is the S&P 500 volatility, just like you can trade OVX, is it off the top of my head, the oil volatility ETF, you can trade euro volatility. Now, there's no volume on this, which is unusual because I would have thought there would be, but thinking about currencies, you can hedge off some of the volatility a little bit easier, can't you, by kind of trading a basket of currencies. You can do lots of spread type trades, lots of options involved in it. So perhaps a pure volatility play isn't that exciting. And it's a kind of chicken and egg syndrome with a lot of these things, guys, is that, if there's no liquidity in the market or no volume, it's not going to bring in people like you and I, because there's no way we're going to start trading these things when there's no liquidity or volume. As speculators, as traders, looking to make some money from the differential between price and the fluctuations. So we're not involved in it. If companies don't see the liquidity in there, they don't want to be involved in it. They want to be trapped in it. So it's kind of one of those things, isn't it? So whenever there's a new product that's brought out, they try to encourage lots of people to provide liquidity. And it has been, they say actually to a lot of prop firms and stuff, hey, you can trade this for free. There's no charge, no exchange fees. We just want liquidity in there. And they try to push a new contract out they think is going to be big. Anyway, digressing slightly, those are the 6 unusual things you can trade. There are plenty more. If you've got any, you've only heard bizarre ones, stick them in the comment section below. Take care, guys. Bye-bye.